into two halves, and that is the beginning of our market where we did see a good performance, and that was off the back of the performance from the US, where we did see the fourth consecutive session of gains. And then after the data, now we saw two pieces of data come out. Locally, we saw the consumer confidence numbers coming out. They were down 0.1% month on month. But what we are probably seeing in these numbers is that we are seeing consumer confidence bottoming out, and after the election, we'll probably start to see this rise again, and that should be a positive for some of the retailers. Yet, despite that, we did see stocks like David Jones down by about 2% and JB Hi-Fi down by around about 1%. And then, of course, came the China numbers at midday. And if we have a look at midday, that was where the big reaction by the Australian share market really was. Those trade numbers much worse than anticipated. On the export side, we saw a decline of 3.1%. The market was actually expecting to see an increase of 3.7%. And on the import side, down by 0.7%, we were expecting to see a bounce of 6% for the month. So unfortunately, not a good set of numbers. The numbers probably do reflect that we are seeing some of the cleaning out of the shadow banking in China because of what's happened in terms of the liquidity. So some of those numbers are probably being driven out of the numbers, but still the market reacted to that, and we saw a strong reaction in terms of the Aussie market as well as the Aussie dollar.
The outlook for our equity market, if you've got a strong US and we get more strong leads from the US, but I mean, offset or countered to some degree by ongoing concerns over China. I mean, how does it play out, do you think, on our market?
It's a double whammy for our market and a double negative for our market. A strong US, meaning a strong US dollar. Not good news for a lot of Australian company earnings and also fund inflows into Australia. And also, if we have a look at the China picture, well, that has a big impact in terms of our market, especially in terms of the material sector. Having said that, one area that's been very strong has been the healthcare space. We've seen the defensive areas really outperforming, and the healthcare space was the best performing area in the last financial year, with growth of around about 40%. We saw the same thing occurring today, the healthcare space outperforming on the market, and stocks like CSL, Ramsay Healthcare seeing an all-time record high. We've also seen a bit more confidence, I think, coming back into the market despite the volatility that we've been seeing. We did reach 4,950 points today, so just 50 points off that 5,000 psychological point mark, and that's been good news for some of the wealth managers. We're seeing cash levels at a record, still near record lows, and of course, with our bond yields rising, it means bond prices are rising. So some of those wealth managers doing very well. In fact, Magellan Financial Group actually hitting another all-time record high today. We also saw Platinum reaching a 52-week high. Also, in terms of these stocks, we are seeing performance fees coming back into the picture, so that's another positive there. And Flight Centre, it hit another record. It, of course, saw a profit upgrade last week, and that's despite the Australian dollar being in a decline. So it does look like Flight Centre still doing well there. But I think in terms of the market, really in terms of the US and in terms of the China, it's a double negative at the moment. We're seeing a stronger US dollar, which is a negative for Australian equities in the short term. And I guess in terms of the China demand story, that's negative for the Australian market as well.
Julia, just on Flight Centre, how much further do you see this stock potentially going to the upside? I mean, as you say, hitting another record, a couple of upgrades to earnings over a couple of months always helps, but my understanding is there's still a fair degree of short positions in this stock, despite it being at an all-time high. Someone's losing money.
I mean, the earnings has been so strong for this stock, and the earnings momentum as well as price momentum continues, but in a way it also defies logic, because if we have a look at Flight Centre's models, it does have a lot of physical stores, and I guess in terms of those physical stores, it isn't the place to be at the moment. I mean, you just have to have a look at Billabong's model to see how it can sometimes weigh down our business. But Flight Centre does seem to have a very strong distribution. It is very large, so it has economies of scale. And over the last couple of years, what we have seen is a very strong Australian dollar, which has encouraged international travel by Australians. Now, with that Aussie dollar coming back, we know that the last financial year that it's going to report on is going to see very strong numbers. But I guess what the market is curious about is the next financial year, the current financial year that we're in now. So with the Aussie dollar pulling back, is that also going to see an impact in terms of Australians travelling overseas and in terms of Flight Centre's profitability? And I think that's the key risk for Flight Centre at the moment. But for the time being, earnings momentum, price momentum, all going in the right direction for Flight Centre shareholders.
Look, fairly or unfairly, quite often labelled as a bit boring. I mean, essentially, they take money from people who travel on roads. Backed up today, though, by its share price performance. A little bit boring. It was flat.
Yeah, absolutely. I mean, toll revenue was up by 6.8% for the quarter, and that was good. And that was really backed by its largest asset, which is the CityLink asset in Melbourne, which saw some strong numbers in terms of revenue. We saw growth of 5.6% and traffic growth of 3.2%, and some movement in terms of their US toll roads. So it looks like they had a weekend of free tolls, and that really helped to increase the traffic in terms of that 495 expressway in the US. But altogether, a really flat performance by Transurban. And I guess if you have a look at the share price performance in the year to date, it's already up 12% in the year to date. It's already beating the market. You're probably not getting into this stock at this stage for any sort of capital gain. Really what you're looking towards is this forecast yield, which is around about 7% for Transurban. So really quite an income stock at the moment, and you're not really expecting to see much growth in terms of the share price.
All right, Julia Lee, as always, great to get your analysis.